Who are the external users? The external users are the government, the creditors, we have the employee, we have the lenders, we have the owner of the citizen. Those groups, we have internal users and external users, but external users are the outsider that need accounting. We have financial analysts, so that is why accounting information is mainly used for the external user, unlike the management accounting, which is used for internal user. But financial accounting information is mainly for the external users, like creditors, like suppliers, customers, financial analysts, government, art regulatory, and many others. The answer for number 4 is option A, which is management. Why is it management? The question says which of the following is not an external user of accounting information. The reason why management is an external user, but creditors, shareholders, and government, they are the external users of accounting information. The answer for number 5 is option C, which is make decisions. The objective for preparing financial statements is for the users, which are the external users who need the financial information for one purpose or the other. So when an accounting information is prepared for an external user, it enables them to make decisions based on that information. So the purpose of using information for the user is to make decisions. The answer for number 6 question is option A, which is accounting ethics. The standard of right and wrong conduct that applies to accounting profession is said A, accounting ethics, business ethics. So this one is referring to the right and wrong which applies to accounting profession, which is the accounting ethics. The last answer, which is question 7, is the option C, which is integrity. Which is the integrity. Integrity is one of the accounting ethics. We have integrity, we have fairness, we have impartial, and the like. So one of the ethics of an accounting is where we find what we call integrity. Under the theme 2, we will be talking on principles and concepts of accounting. Under the theme topic, we have topic 1, which is principles and practice of double entry. What is double entry? Double entry bookkeeping is the system of keeping accounting which take advantage of twofold aspects of every transaction, whereby one account that received is debited and another account which received is credited. That means each item that is treated must have 2 accounts, two ledgers, using double entry principles. Rules of double entry principles. Double entry principle states that for every credit in an account, there must be a corresponding debit entry in another account. Like I said the other time, I lay emphasis on that accounting must have every transaction, every item, maybe from source document or any other source, must have 2 accounts. When one is credited, then the other must be debited. In doing this, you are complying with the rules of double entry. The second rules of double entry states that for every debit entry in an account, there must be a corresponding credit entry of another account. The third one says all transactions must be recorded in 2 accounts. Like I've said, that one account is debited and another account is debited. That means in an account, for you to must have comply with double entry, then every item must be posted twice. One that has the corresponding debit entry must have a debit entry, while one that has debit entry must also have the credit entry as well. Now, we'll be talking about applications of rules. Those rules that have been mentioned above, how to apply double entries with illustrations. Before we go to the illustration, number one, the application is that any transaction which involves two accounts, any transaction involves two accounts. That means the receiving account, the account that received, or we call it receiver account. B, we have giving account, which is or you can also call it giver. That means credit the giver, credit the debit the receiver, and credit the giver. That is the rules of double entry, of which we are going to apply in this topic. The second one is one account will be debited and another will be credited. When like I said the other time, that when one account is credited, then fulfilling the double entry, you must credit the second account. Or if one account is credited, then you will have to debit the second account. A, we have debit. That means receiving account. When money comes in, it must be recorded, it must be posted on the debit side. And B, which is credit side, is when account goes out, when the money goes out, we call it giving account. When the money goes out, like pay dollar and some amount of money, you credit it because the money goes out. Now, what are the illustrations? These are the questions that we are given below, applying the double entry principles to have fundamental knowledge of accounting, because the fundamental knowledge of accounting must be compliant with what we call double entry principles. Every account not just appear like that. They have the rules that you must follow, which is the double entry principle. Every ledger must comply with what we call debit double entry principles. Number illustration that we will be dealing with is Bola start a business with 200 naira in a bank on November 1. How are we going to apply our double entry principle with this question? Number 2, we have bank cash 400 on November 1. The third one is sales goods on credit to Mayowa 60 naira on November 6. Then we have number 4, bought furnitures for cash 100 naira on November 7. Number 5 question says purchase Merchant van 350 on credit from Tunde on November 9. 6 question says sales good on cash to Bola 20 naira on November 20. Number 7 says purchase goods on cash from Tunde 100 naira on November 21. Question 8 says pay wages 20 naira cash on November 22. Goods returned to us by Yemi 700 naira on November 22. And the last but not the least, which is number 10, we return goods to Joy 70 naira. We'll be taking the illustration with examples using ledger to prepare the double entry principles. We'll be taking it simultaneously, one after the other. Bola started a business with 200 naira in bank on November 1. The two accounts that we are going to consider here is two accounts. Bola started a business. Anything that used to start a business is what we call capital. So we are going to prepare capital account. Then with 200 naira in bank, that means he started a business of 200 naira, which is the capital in bank. We are going to prepare another account, which is a bank account. These are the two accounts that we are going to prepare. In doing this, if we just prepare capital account only, and you know we said the other time that debit side is a receiver, while the credit side is the giver. When money goes out, is this is the way we credit money that goes out, and we debit money that comes in, or when you receive money. Now, capital account, Bola start a business, it means the money goes out. So we are going to prepare capital account. This capital account, and this is a ledger. So this is debit side and this is credit side. Capital account we start a business, that means the money goes out. So anything that goes out must be credited. So you write November 1, bank. How much is it? Is 200 naira. So that is that for capital, because the money